Hello dear friends, welcome back. Previously, we explored the critical role of NABARD playing in promoting rural development, agriculture and financial inclusion in India. We covered how NABARD supports sustainable farming, provides credit facilities, empowers self-help groups and as well fosters innovation through programs like VLPs and M-Suvidha. Today, we will dive deeper into the challenges and issues in regulation of microfinance and strategies that are continuing to transform rural India's economic development. Just imagine a world where even the smaller farmer or the local shopkeeper can access credit and financial services. Microfinance has turned this vision into reality, bringing economic empowerment to millions of low-income individuals and small enterprises. But with great growth comes great responsibility. As microfinance expands rapidly, the need for effective regulation has never been critical. In today's session, we will dive into the challenges and issues faced in regulating these sectors. Firstly, diverse institutional structure. One of the primary challenges in regulating microfinance is the shared diversity of institutional structures within the sector. For instance, imagine a rural woman borrowing from SHGs and non-government organization backed microfinance initiative and even a formal regional rural bank. Each of these institutions operates under a different regulatory framework. SHGs, these are community-based groups pooling resources and providing loans to their members. Whereas NBFC, MFIs, these are formal commercial entities providing microloans. Next one, cooperative banks and NGOs, often regulated by state laws or not at all. The challenge: policy makers struggle to create a cohesive regulatory framework that applies uniformly across all these types of institutions. Without such a framework, these inconsistency in oversight leading to potential risks for the clients. Secondly, client over-indebtedness. One of the biggest concerns in microfinance is client over-indebtedness. Borrowers often take multiple loans from different sources, sometimes formal, sometimes informal. Regulators face a tough task, ensuring that clients access to credit without falling into a debt trap. However, setting strict loan limits is difficult in countries with fragmented oversight systems. And let's not forget the informal lending markets that operate beyond the regulatory reach. Next, high interest rates and lack of transparency. Microfinance institutions often charge high interest rates to cover the cost of delivering small, unsecured loans to the remote areas. While these rates are lower than traditional money lenders, they can still be burdensome, especially when terms are unclear. Regulatory bodies face the challenge of setting appropriate interest rate caps. Too low, and MFIs may stop serving rural or underserved areas. Too high, and vulnerable borrowers suffer. Transparency is the key, but enforcing it is a constant challenge. Next, consumer protection and grievance redressal. In many countries, low-income borrowers lack financial literacy, making them vulnerable to unethical practices, coercive recovery, hidden fees, and unfair loan terms. Regulators have responded by establishing codes of conduct for MFIs. In India, MFIs are required to have grievance redressal mechanisms. But enforcement is a question mark. That's another challenge. Imagine the borrower frustrated because the process to file a complaint is slow and opaque. Without a strong system, borrowers are often left without adequate protection. Next, political interference. Political interference can be a double-edged sword. Loan waivers or interest rate caps are often introduced during election seasons, offering short-term relief for borrowers but undermining the long-term health of MFIs. Regulators must find a balance between political pressures and maintaining the financial stability of MFIs. Next point, regulatory arbitrage. Regulatory arbitrage is when institutions exploit differences in regulations to avoid strict oversight. For instance, NBFCs, MFIs may face more stringent regulations than SHGs or non-NGOs. As a result, some institutions might restructure to operate under more lenient rules. This practice not only undermines the integrity of the sector but also increases risks for borrowers. To combat this, regulators need to harmonize regulations across different types of microfinance institutions. But that's easier said than done, given the diverse nature of the sector. Moving on to next point, inadequate data and reporting systems. Effective regulation depends on accurate data. However, many smaller MFIs, especially in rural areas, lack the systems to collect and report data consistently. This makes it difficult for regulators to monitor the sector or assess risks. Imagine trying to regulate a large sector when you don't have a clear picture of what's going on. Without standardizing reporting, ensuring transparency is a challenge. Building better data systems is crucial for effective regulation, but it remains one of the major hurdles in the sector. Moving on to next point, balancing social and commercial objectives. Microfinance has a unique challenge, balancing social and commercial objectives. MFIs are expected to serve the poor while remaining financially viable. In this room, you can see the dilemma. Focusing too much on commercial objectives might push MFIs to prioritize profits, charge higher interest rates, and impose strict repayment terms. Whereas On the other hand, if they focus too much on social objectives, they risk becoming unsustainable. Regulators need to design frameworks that encourage a healthy balance, allowing MFIs to remain financially viable while fulfilling their mission of financial inclusion as well. Next point, technology and digitalization challenges. The rise of digital microfinance services has made financial inclusion more accessible. But with technology comes new regulatory challenges. Data privacy, cybersecurity, and the risk of over-indebtedness from easy access to digital loans are significant concerns. Imagine this borrower now able to apply for multiple loans with just a few clicks, potentially leading to over-indebtedness. Regulating digital lenders requires updating existing frameworks, ensuring they adhere to the same standards of transparency and consumer protection as traditional MFIs. Next point, impact of external shocks. Microfinance clients are often vulnerable to external shocks, economic downturns, natural disasters, pandemics like COVID-19. These events can lead to widespread defaults, putting immense pressure on MFIs. Like during the COVID-19 pandemic, many governments introduced loan repayment moratoriums. But such measures can strain the financial health of MFIs. Regulators need to develop resilient frameworks that can support MFIs during crisis while protecting borrowers from excessive financial stress. In conclusion, the regulation of microfinance is complex, with challenges ranging from diverse institutional structures to political influence and the rise of digital services. But with thoughtful policies and collaboration, regulators can create frameworks that protect borrowers while ensuring the sustainability of MFIs. As we look to the future, the balance between financial inclusion and regulatory oversight will be the key to the continued success of microfinance. Thank you for joining us on this journey to the world of microfinance. All these essential financial products are transforming lives of millions. So remember, one loan, one remittance, and one lesson at a time. Stay tuned for our next interesting topic. Thank you.